So, good evening, friends. I'm Yojal Agrawal. I welcome you all on behalf of CICAS Welfare Association. This CICAS Welfare Association is a Section 8 company which was formed somewhere in 2024, having an idea where we can help the members who are facing some challenges, especially like few of the members, while they are facing some medical issues, their families are facing some critical financial issues. So the idea of creating this CICAS Welfare Association is where we can hold the hands of members and their families so that they should not face any problem. In the time to come, we are planning to have some portal also, especially for the members who just wanted to work as a freelancer, or maybe the woman member who wanted work from home kind of opportunity, or the members who are getting retired from either the government job or from the private sector, and after that they wanted to act as a freelancer. So this portal shall be instrumental. Maybe in another month's time we are working on that. But at the same time, now we restarted this virtual meeting, and today we are going to discuss about transfer pricing regime under Income Tax Act 2025. And for discussing the subject, we have with us CA Yojal Agrawal. She is a chartered accountant originally from Aligarh. Nowadays, she is settled in Bareilly. Earlier, she was in Farrukhabad, and she is having very good experience, especially in transfer pricing, as she was with Big Four, and the knowledge which she is having is very good, and I'm sure we are going to get benefited from her knowledge, especially on the topic transfer pricing regime under the Income Tax Act 2025. What I request during the session, we may be having certain questions, members may be having certain questions, so we can put these questions into the chat box, and then after that we can take it one by one. And by any chance, if Usual wanted to take the question in between, then Usual can take the questions in between as well. So without wasting much of the time, I invite Usual to start her deliberation and to teach us what all the changes are there, and what all important points are there, especially in transfer pricing regime under Income Tax Act 2025. As per my understanding, which I got after reading this Income Tax Act 2025, I believe government tried to simplify certain rules, but still transfer pricing is a complicated subject. So the judgment I am leaving on Usual and the members who are listening this topic. So over to Usual for further deliberation.
Thank you, sir, for the kind introduction, and thank you for the opportunity to present my um, the simple knowledge that I have about transfer pricing. And good evening, everyone. And I really thank you for this joining this session on the transfer pricing regime under Income Tax Act 2025. My name is Yojal Agrawal, and I'm a chartered accountant with over 7 years of experience in the field of transfer pricing. Previously, I was working with EY in the transfer pricing team. Post that, I started my own practice. So I'm delighted to be with you today to discuss some of the key transfer pricing changes introduced under the Income Tax Act 2025 and their practical implications. While the new Income Tax Act is a largely reenactment exercise, it also introduces several important structural and procedural changes that we as consultants and the taxpayers need to understand. In today's session, we will focus on four important areas. First, we will discuss the revised associated enterprise framework under Section 162, which has replaced the erstwhile Section 92A, and examine whether the new definition could potentially widen the scope of transfer pricing applicability. Secondly, we will review the amended safe harbor regime, which seeks to provide greater certainty and simplify compliance for eligible taxpayers, especially the ITES and KPO and the software development industry. Third, we will look at the changes in the APA framework and how the government is attempting to make dispute prevention mechanisms more accessible and efficient. And finally, we'll discuss one of the major changes in the Income Tax Act 2025 is with respect to Form 48, which you will understand as erstwhile Form 3CEB, and it significantly expands the transaction level reporting and disclosure requirements. So, with this background, let us begin with one of the most fundamental questions in transfer pricing: when do two entities become associated enterprise? Because the TP provisions are triggered only when the transactions occur between entities that qualify as AEs. So, under the erstwhile Section 92A of the Income Tax Act 1961, the determination of an AE relationship was often viewed through the lens of management, control, or capital participation. Certain judicial precedents, such as Veer Gems, Page Industries, they have also interpreted that the participation test under subsection 1, together with the specific deeming conditions prescribed under subsection 2. Now, Section 162 of the Income Tax Act, it marks a significant shift. So while many of the existing thresholds have been retained, the new provision consolidates the participation and deeming test into a single framework, and it places a greater emphasis on the economic dependence and commercial influence in addition to the traditional control-based indicators. So as a result of this change, the relationships that may not have been regarded as AEs under the earlier interpretation could now potentially fall within the transfer pricing net. So the objective overall appears to be reducing the ambiguity and expanding the scope of situations where an AE relationship can be established. So as you can see on your screen, this is a basic comparison of both the sections. The language is same, but the interpretation has changed. So the new act rationalizes AE provision. It consolidates subsection 1 and 2 of 92A into a single framework under Section 162. Under the 1961 Act, considerable litigation arose regarding the interplay between subsection 1 and 2, and several judicial precedents have held that in the past that specific conditions contained under 92A2 could not be read in isolation and had to be interpreted together with the broader participation requirement prescribed under subsection 1. So, if an entity is falling under subsection 1 but is not fulfilling any of the conditions under subsection 2, they were not considered as associated enterprise, and vice versa. But now, under section 162 of the new act, it seeks to address this ambiguity by embedding the traditional participation test and the prescribed threshold based conditions within a unified definition. We will understand the difference through illustration in our next slides. So, as a result, the statute now expressly recognizes relationships arising through management control, capital participation, economic dependence, and other specified criteria as it is visible on your screens. So, as we can see that while the numerical thresholds have largely remained unchanged, such that loan advances and guarantees, etc., but the legislative structure has been significantly redesigned. The focus has shifted from interpreting the interaction between two separate subsections to applying a single comprehensive test for determining AE relationships. So, as a result, certain arrangements that may previously have been outside the TP framework due to interpretational disputes could now fall within the scope of a new AE definition. Thereby, it will expand the reach of TP provisions. Now, we cannot just depend on whether the AE uh, are completely subsidiary or a parent company. We will have to get into the books of accounts to understand certain conditions. So the focus has shifted from interpreting the interaction between two separate subsections to applying a single comprehensive test. So now we need a more proactive and strategic TP approach to manage compliance and litigation risk effectively. So, as to summarize, the old act, which provided a two-step framework, the new act is providing a single consolidated framework. The old act focused mainly on the management, control, and capital, but the new act is giving other prescribed conditions, as we can see on our screen, is if the loan advanced is greater than 51% of the book value of total assets, and if there's a guarantee of more than 10% of the total borrowings. So we will have to address these conditions. Along with that, we can see that the old act was completely, to some extent, settled by Supreme Court through its judgments in VGEMS and Page Industries, that we have to read subsection 1 and 2 together. But under the new act, now that these conditions are embedded in a single unified framework, this may lead to certain entities becoming A. Now let us understand this through examples. So in our illustration one, as we can see, there's a foreign company which is providing loan to an Indian company. So if it falls within the prescribed quantitative thresholds of the section 162, then it can be classified as a E. Under the previous act, unless the influence or control was established, entities could not be classified as AEs, even though they were crossing the threshold limit. However, under the new 2025 Act, there is higher likelihood of the entities being classified as AEs because under Section 162, loan provisions have been incorporated as a separate condition to establish the AA relationship regardless of the management and control. So we as consultants need not rely on the disclosures made by the management, and will have to actually go into the books of accounts to check whether these thresholds are being met or not. Now, similarly, in illustration 2, if an Indian company is procuring more than 90% of its raw material from certain suppliers, and these suppliers have been designated by its foreign company, and the pricing terms are also substantially influenced by the foreign company, the AE relationship may be established, which was in the past escaped under the past act. So the question comes, what does this actually mean in practice? The first and foremost impact is that more transactions are going to become reportable under the TP provisions. Relationships that were previously not viewed as AEs may now need to be reevaluated in the light of the broader framework under Section 162. So, as a result, determining whether an AE relationship exists will no longer be a compliance exercise undertaken at year end. Instead, it will become an important consideration at the transaction planning and structuring stage itself. As Atul sir in the starting of the session also mentioned that the new act is focusing more on maintaining books of accounts. So I believe that books of accounts will come in handy when it comes to seeing the applicability of the transfer pricing provisions, because determining an AE is the first step. So, at the same time, the revised framework is likely to generate certain interpretational challenges because questions may arise around indirect participation through multi-layered ownership structures, the computation of asset-based thresholds, where valuations fluctuate significantly, the treatment of guarantees, and implicit financial support arrangements, and the extent to which supply dependency creates an AE relationships. So, from a governance perspective, companies are likely to place greater emphasis on TP health checks and risk assessments. We may also see increased focus on restructuring reviews, shareholding mapping exercises, and a closer examination of intercompany agreements, financing arrangements, and procurement structures. So ultimately, through this, there is the key takeaway is that AI analysis becomes even more critical because an incorrect conclusion at this stage can have a cascading impact on the TP documentation, reporting obligation, and potential litigation exposure. Let us now turn to one of the most taxpayer-friendly changes under the new TP regime, which is the revamped Safe Harbor framework. Under Section 167 of the Income Tax Act, it continues the safe harbor framework where the entities can accept, where the tax authorities, sorry, can accept the transfer price or the deemed income declared by the taxpayer, provided the prescribed conditions are satisfied. Safe harbor was majorly introduced to bring certainty and reduce litigation burden on the entities. Now, the revised framework brings more uh, certainty into the picture. Now, it significantly enhances certainty and ease of compliance, especially for entities being covered under the broader framework of IT services. As we can see on our screen, the first is the turnover threshold, which has been so far one of the biggest relief for the IT industry, because the threshold has been substantially increased from 300 CR to 2000 CR. So now the entities which are not being covered earlier can now opt for safe harbor regime. This dramatically will expand the pool of taxpayer that can potentially avail this regime. Secondly, the prescribed operating margins have also been rationalized, because earlier safe harbor margins were ranging from 17 to 24%, which did make the regime unattractive, because there were certain entities which were being compensated from their foreign entities or related party on a 15% margin or a 16% margin. But now the revised margin has been safely set at 15.5%, which seems to be significantly more practical and commercially aligned according with the market rates. Now, third, once exercised, the option is going to remain valid for a block period of 5 years, which is a big relief from the benchmarking exercises that needs to be carried down every year in the current TP regime. And it is going to provide a long-term certainty and reviews and reduce annual compliance disputes, allowing the entities to focus more on the business. And moreover, this once the option that is validly exercised, it will remain effective for 5 consecutive years. And the most attractive point is that the 2,000 crore revenue threshold is tested in the first year itself. So even if you're crossing the threshold in the second year or the third year, you still remain valid for safe harbor regime if you opted it for in the first year. This is going to provide major certainty to the entities for the entire block period. So collectively, I feel that these changes reflect a shift from a litigation-oriented approach towards a certainty-driven framework for low risk captive service providers. Now, the revised rules, they also simplify the scope and administration for a safe harbor regime. One of the most significant changes is the consolidation of various technology-enabled services into a single IT service bucket. In the past, entities used to be confused about what service line will they fall into, or we have clients where an entity which is providing a software development service is also providing KPO services. So that created a more segmental workings and confusion for the entities. Now these entities pursuing activities such as ITS, KPO, software development, contract R&D, they are now grouped together under the IT services bucket. So they are saved from the exercise of examining under which regime do they fall into. So this is going to removing a long standing source of controversy where taxpayers and authorities also frequently debated what is the correct classification of services. And this is going to bring a lot of certainty. However, we need to keep in mind that the new regime is available only to the low-risk captive entities, which are undertaking qualifying international transaction. If your entity is doing certain entrepreneurial functions, it holds significant IP, then it cannot opt for the safe harbor regime. Therefore, consultants and the taxpayers must evaluate whether their functional and risk profile align with the prescribed conditions. And this should be a year starting exercise, not the year end exercise, because the compliances will be complied by accordingly. So, from an administrative perspective, the process under the safe harbor has definitely become more streamlined, and the taxpayers are required to electronically file Form 49 with DGIS systems, and the eligibility verification is carried out through an automated rule-based mechanism. Thus, as we can see that the application is no longer dependent upon detailed examination by the AO at the initial stage. So this will reduce subjectivity and it will improve predictability for the taxpayers. However, we must always remember that safe harbor regime, it does not eliminate the transfer pricing compliances. Even in the past, even if you're opting for safe harbor regime, you will have to maintain the documentation, because it was a common misconception that now that we have opted for the safe harbor regime, we are earning the margins as prescribed by the authorities. We don't need to prepare the documentation. But the documentation and the accountant reporting is these are the requirements that that continue to apply. We may be saved from doing conducting the benchmarking exercise, but the documentation and the form 48 and the erstwhile form 3CB continues to be filed every year. So we must maintain records which support the eligibility, characterization of services, computation of margins, and consistency with the low risk captive model. Therefore, the safe harbor should be viewed not as an exemption from transfer pricing, but as a mechanism for obtaining certainty regarding the arm's length nature of the covered transactions. While I agree that safe harbor does provide certainty through prescribed margin, advanced pricing agreement framework, they continue to offer the certainty through agreement with tax administration. So safe harbor is an exercise that the tax authorities prescribe the margins, and you try to come within those margins, or if you already are there, you opt for the regime. But under the APA framework, there are certain kinds of APAs such as unilateral, bilateral. So in unilateral APAs, you enter into an agreement with the tax authorities before entering into transactions that this is the margin that we are planning to keep, and through negotiations, if the tax authorities agree, then you reduce your litigation exposure. So, in the new Income Tax Act, it introduces a fast track APA mechanism which aims at reducing timelines and improving taxpayer experience. As we all know, under the past act, the APA negotiations used to go till long periods like 4, 5 years, 6 years. Sorry, which used to create a lot of ambiguity. And we all can agree within 5 years and 6 years, the company's business and margins are bound to change. But now it has been set at a 2 year period where the negotiations have to be completed, and additional 6 months if the taxpayer requests. So now the objective is straightforward: providing advanced certainty while reducing administrative burden and prolonged negotiations. So the revised framework, it also broadens accessibility by permitting applications from the IT services sector and introducing a standardized electronic process. Previously, the APA process used to be manual filing, but now we can go for electronic filing. So collectively, I agree, and we all can agree that these changes, they demonstrate a policy shift towards certainty, dispute prevention, and ease of doing business. It allows electronic filing and proposes a single flat fee for application.
Um,
So, yes, sir.
Yojal, just wanted to ask one question in between,
Sure,
as you
sir.
were talking about electronic filing, right? So,
Yeah,
as of now, while we are into the transfer pricing, normally TP report is being submitted only once the assessment process is going on, right?
right.
So, with this process, the assessee or the chartered accountants are bound to file the TP report along with the Form 3 CEB, or the process will be the same. Like if the assessment process is going on, then only we have to file this TP report.
So TP documentation will be filed during litigation, uh, but uh,
During
uh, I,
litigation, right?
yeah, but I'll be discussing in future slides that how Form 48 incorporates TP documentation into itself. So now
Correct.
it's just not merely a reporting exercise. It's it's
Okay.
it's going to be a long process.
Okay. Okay. No, please carry on. Please carry on.
Yeah, yeah, sure, sir. Thank you. So now we'll compare Safe Harbor and APA. This will help us analyze the situations where they can be made applicable respectively. So in Safe Harbor, as we saw that the turnover limits are set at 2000 CR, but in APA there is no turnover limit. And the operating margins in Safe Harbor, they can be more than 15 to 15.5%, but under APA, they can be different from the Safe Harbor regime as negotiated with the tax authorities. Safe Harbor is strictly restricted to the routine or captive entities which are functioning with limited risk and no significant ownership, IP ownership. But APA is more suitable for entities that are doing more entrepreneurial functions and IP ownership, who are procuring clients and they are assuming higher risk. Safe Harbor, there is no application fee that has been prescribed, but for APA, there is a standardized fee of rupees 2 millions. So, but we need to understand that in Safe Harbor, the most important step is not filing Form 49. The first step should be testing that whether our Indian entity is actually eligible or not. Even if our entity is meeting a 15.5% margin threshold, that doesn't mean that we can file for Safe Harbor eligibility. So this requires a detailed analysis of the functional profile and the risk assumed by the entities to satisfy the prescribed condition. Suppose a contract is saying limited risk provider, but that's not enough. The rules make it clear that if the contract says that the foreign principal controls the risk, but the conduct of the entity shows that the Indian entity is actually doing the business, it's taking the roadmap decisions, it's controlling the key technology, managing strategic risk, or developing valuable intangibles in substance, the safe harbor eligibility, it may become questionable. So the real work is in eligibility testing, conducting review, margin modeling, and document readiness. Under the APA, on the other hand, it is a customized arrangement. It requires our more time, effort, and analysis, but it offers greater flexibility and can accommodate complex business models, valuable intangibles, entrepreneurial risk profiles, and bilateral certainty. So, as consultants, the responsibility falls on us to guide our clients which regime will be beneficial for them. Now, let us understand the difference between Safe Harbor and the APA through two illustrations. In the first example, as you can see, the Indian entity, it is a captive service provider, which is earning a margin of around 12% from its foreign holding company. This margins are below the Safe Harbor prescribed 15.5% threshold. Therefore, Safe Harbor becomes unavailable. However, the company may still pursue APA because APA eligibility is not dependent upon the prescribed margins. However, in the second example, we can see that the margins are exceeding the safe harbor threshold. So at the first glance, company appears to be eligible. However, the analysis, it does not end here. The taxpayer must still establish that it qualifies as a low risk captive service provider and it satisfies all the prescribed eligibility conditions. This is where the real work lies for us as consultants, also doing the correct functional analysis, risk evaluation, conducting a review, and the proper documentation. The decision between Safe Harbor and APA should be driven by the actual business model rather than by margins alone. Now, I'll be coming to one of the most significant changes under the 2025 Act is the transformation from Form 3CB to Form 48, and which holds a greater significance for us as consultants also. It's just not, we need to realize that it's not just a change in the number of the form. It is not merely the addition of new fields in the form to be reported. It now fundamentally changes the role of accountants report. The department is specifically not the department, sorry, the government is specifically moving from the era of summary reporting to analyzing the transactions on the face of the form itself. Now we need to understand what are the key changes. So first, the accountant, us as chartered accountants, we are now expected to provide greater verification regarding the maintenance of TP documentation, examination of the agreements, and consistency with books and records. Second, the transfer pricing study itself is effectively embedded into the reporting framework. Sir, this answers your question, whether do we need to file the TP report? We don't need to, but effectively the TP report is there in the form itself. Because we now need to disclose the method that we have selected, which was, I agree, previously was disclosed, but the benchmarking approach adopted should be disclosed. What is the arm's length range and what is the comparable set used? So this is effectively going to end the era where we used to follow the approach that file now and prepare TP study later at the litigation stage. Thirdly, the reporting is moving from a summary-based approach to a transaction-level framework through unique transaction IDs, APA cross-referencing, and transaction-wise mapping. Therefore, as a result, Form 48, it no longer functions as a standalone compliance form. It acts as a bridge between the TP study, the books of accounts, and the tax authorities. So the key amendments to Form 48 include that we now need to disclose the international transactions, the deemed international transaction, and the specified domestic transactions separately, and they will be mapped through unique transaction identifiers. The form also introduces several new reporting categories, particularly for technology and service-based industries. In addition to this, the taxpayers must specifically identify APA covered transactions. They must disclose the arm's length price computations, which were not previously disclosed. They must provide the segment wise profitability details, furnish extensive information relating to the financial transactions, royalty payments, guarantees, business restructurings, and ESOP recharge arrangements. This places a greater emphasis on the intercompany agreements also. Um, it's been more than 7 years I've been doing TP, and what the clients generally used to follow the approach is making agreements backdated. But that's not the case now because you need to disclose if the entities are entering into any intercompany agreements on the face of the form itself. So now we all can agree and see that the Form 48 is no longer merely a reporting form which was there under Form 3CB. Now it is effectively becoming an extension of the transfer pricing documentation itself. So even before the litigation starts, the TPO knows, the assessing officer knows what are your margins, what are the companies that you have selected for your comparables, what is your range, and what is your company's margins. Now, the most notable shift under Form 48, it is the integration of reporting and TP analysis. So under the earlier regime, we used to disclose only the transaction values and keep the detailed benchmarking analysis largely remained with the transfer pricing study. I have come across many of the cases where I'm being approached by consultants or clients to conduct the benchmarking study for past 3 years or 4 years because the litigation has opened up. That cannot be the case now. Now, Form 48 is changing that approach. As we discussed in previous slide, that the accountant is now required to report upfront and on the face of the form the benchmarking methodology that has been adopted, whether the transactions have been aggregated or segregated, the profit level indicator that have been used, the number of companies that have been selected as comparable, the arm's length range, the adjustments made, and the final arm's length conclusion. Therefore, the benchmarking exercise becomes imperative on the face of the form itself, and that needs to be conducted before filing. Further, APA details are also need to be disclosed, such as the acknowledgement numbers, the transaction mapping must also be disclosed wherever applicable. So as a result of these changes, the tax authorities are already getting the concise summary of your clients or the taxpayers' transfer pricing position without waiting for the detailed TP documentation during assessment proceedings. I have encountered that unsaid rule that if the litigation has opened up, we used to conduct a fresh search, select the comparables with more details. That is now out of the picture. We need to be very careful on the date of filing the form itself. Now it is clear that the era of delaying benchmarking has ended. Previously, as I discussed, the unsaid rule was file 3CB today, prepare TP study later at the litigation stage. However, Form 48 has structurally altered that rule, because now Form 48 is your TP study itself. In practical terms, the form is substantially reducing the gap between the TP study and the accountant's report. So now we all can agree that greater disclosure will bring greater scrutiny. So now the taxpayers are required to disclose detailed benchmarking. Inconsistency that may have previously remained buried within the TP study can become immediately visible to tax authorities. As I told you, there were cases where we used to conduct a fresh benchmarking research when the litigation has opened up. That cannot be the case now. So particular attention should be paid to the classification of transactions, the identification of the deemed transactions, what are the comparables that we are selecting, what are the adjustments that we are carrying on, and the reason for those adjustments, along with how are our financial transactions are being treated. Areas such as ESOP recharge arrangements, which are very popular in the startup companies, along with the reimbursement that are being made between the entities, and the cost allocation, the free of cost services which are being provided by the entities to each other, they also attract greater examination, because the form now specifically asks for the disclosure of these arrangements. Previously, these arrangements were generally asked by the TPO during the litigation stage, but now they are on the face of the firm itself. So now, as taxpayers and consultants, we should expect the quality of documentation to become more important, and we need to be consistent with our positions that we are taking in the starting of the year itself, not at the litigation stage. So we all can agree the response to Form 48 should not begin at the year-end reporting stage. Businesses should establish systems for identifying, classifying, and tracking the transactions correctly at the time they occur. Transaction mapping, benchmarking, and documentation can no longer be treated as a year-end exercise, and the benchmarking analysis should be completed well before the October deadlines, and taxpayers should ensure that the contracts, invoices, finance records, and transfer pricing documentation remain consistent and aligned. Particular attention should be paid to the intercompany financing arrangements, the ESOP mechanism, the cost allocation, and free of cost services, as these areas now attract enhanced disclosure requirements, which they escaped in the previous 3CB form. So, in a sense, we can say that the objective has moved from a more reactive model to a proactive TP governance framework. And if I had to summarize all the Form 48 changes in one sentence, it would be that transfer pricing compliance is no longer a year-end exercise, as discussed earlier. Data capture, transaction mapping, benchmarking, and documentation must be embedded into the business throughout the year. The key messages that we can take from Form 48 is that transfer pricing reporting is becoming significantly more data-driven and transaction focused. The era of high-level summary disclosures is largely over. The taxpayers must now be prepared to disclose not only the existence of transactions, which was done earlier, but also the underlying TP analysis, the benchmarking approach, the comparables that we have selected, and the arm's length conclusion. Consequently, robust agreements, stronger documentation, timely benchmarking, and periodic TP health checks will become increasingly important. For many groups, the compliance readiness will not be determined by the filing deadline, but by the quality of the systems that they have placed in their entities and the documentation maintained throughout the year. Before we conclude, this slides, it gives us a high-level view of the revised TP reporting framework under the new act. The key takeaway is that the transfer pricing compliance is becoming increasingly integrated with transaction level reporting, benchmarking disclosures, and accountant certification and supporting documentation all being closely interconnected. As a result, the taxpayers should view transfer pricing not merely as a reporting obligation, but as a continuous governance and risk assessment process involving financial, taxation, legal, and business teams throughout the year. So, as we conclude, I would just like to leave you with three key messages from today's discussion. First, the revised AE framework under Section 162, it may potentially expand the scope of TP applicability, and therefore it requires us to revisit the existing relationships and the structures between the entities. Uh, in the past, an entity which was not being considered as an AE merely as a supplier of the goods is may now be classified as an associated enterprise. Second, the changes to the safe harbor and the APA regime reflect a clear policy objective of providing greater certainty, reducing disputes, and simplifying compliance for the taxpayers. Thirdly, and the most important part of the discussion, Form 48, it represents a significant shift in the TP reporting framework. The focus is moving away from year-end compliance towards year-round governance, documentation, and transaction level transparency. So while the TP principles, they remain largely unchanged, the manner in which taxpayers evaluate, document, and report transactions is definitely evolving. Businesses that proactively align their processes with these changes will be better positioned to manage compliance obligations and they will reduce the litigation risk. I thank everybody for their participation and I hope that you found the session insightful and practically useful. I would now be happy to take if questions if there are any.
So usual, I'll start the questions, right?
Sure, sir.
So what I understood, like as the government's focus is more and more on the compliance, and the compliance should be from day one. But on the one hand, we are talking about ease of doing business. But while we talk about the small businesses, don't you think that it would be a difficult task for them because maintaining that compliance, maintaining all records, even if they don't have the accountants? So how will they manage? This is just
Sir,
a basic question. And after that, I'll come on the technical part.
I agree with your part, but the thing is, in transfer pricing, I'm telling you what we have faced it that the entity is coming to me that 3 years Purana litigation has opened up, and now we need to conduct a benchmarking. Our softwares are also not designed such way that we are conducting a benchmarking on the back date. The as soon as you submit your fresh benchmarking conducted to the TPO, he will
Mm.
identify that the benchmarking has been conducted on a later stage. So for entities, I agree it will increase the compliances, but will definitely in the long run reduce the litigation exposure and bring more clarity.
Okay, so while we are talking about the benchmarking, let's say if I am having an associate concern, let's say that associate concern is based in Dubai, right? And I have transferred the share capital there, right? That share capital I might have transferred in the financial year 23-24, right?
Hmm.
Now, this is the financial year, let's say 26-27 or
Hmm.
25-26. Assessment year is 26-27. So, do I need to continue even if there is no change in the share capital? Share capital was transferred 2 years back, 3 years back. Then also I have to go for a TP report every year.
So the TP documentation applicability comes when you're crossing a 1 CR threshold on your transactions. So
Mm-hmm.
if the entities are not conducting any transactions during the relevant years, then we don't need to
It
go
is
for the
not
TP
required.
documentation.
Okay.
Yeah,
And while we talk about the comparables, so you were talking about the benchmarking, and benchmarking is being done on the basis of the comparables which you normally take out from the different softwares, right?
right.
So let's say if you are using Capital Online or maybe some other softwares are there. So normally it has been observed that the comparables which you are taking out from your resources at times are different from the comparables which the department is taking out from their own portal. So, what is the reason for that?
So what happens is that suppose we are conducting a search for the current year. So we will
Mm-hmm.
conduct it today, but the department is opening up the litigation 2 years later. So they will
Mm-hmm.
conduct the benchmarking on that date. So definitely the comparables are supposed to change because every year these softwares also add new companies.
Mm-hmm.
So they do change. That's why during the litigation process, we do go with our previous study that we have prepared. But
Mm-hmm.
if we know that the TPO has conducted a fresh research, we also conduct a fresh research from our side uh, uh,
Mm-hmm.
to bring clarity that the comparables that have been selected by us 2 years back while preparing the original TP study are relevant today also.
Okay. So, like most of the time, it has been observed that if the department is doing search, maybe after 2 years down the line, at the time of litigation, so they normally emphasize on the research what they are actually doing at that time, right? They are not relying upon the data which you are furnishing to them, and they are making an addition on the basis of their own research, and then after that matter is being referred to DRP, right?
Right.
And then again, most of the time it has been observed that the DRP is also not giving a relief to the SSC, and then after that, SSC is bound to go to the ITAT, then only they are getting any relief. So, is there any change in the mechanism now in this new act, in this new Income Tax Act 2025?
So there is no change in mechanism when it comes to selecting the comparables or going through the litigation process.
Hmm.
I have handled cases where the ITAT, like where the assessing officer or the TPO agreed with the comparables that we have selected, and we have, or the cases where we had to go to the ITAT. It just depends, as you know, with other litigation in the income tax also. It just depends on the officer that you're dealing with and how strong your case is.
Okay. So apart from this, like while we are talking about the documentation, so what kind of documentation in normal SSC or a small businessman is required to maintain for this transfer pricing transactions so that they can prove that a small vendor or an SSC can prove that, okay, whatever the transaction is done, that is as per the market rate. So what all necessary documents are required to be kept?
So, sir, firstly, as I discussed, that the first exercise is determining AE, like
Hmm.
whether this entity is my AE or not. If you are saying that yes, it's an AE, then you should have a reason in which clause it is falling. And if you're saying no, it's not an AE, then you should have a very strong justification that this is the reason it's not an AE. Then,
Hmm.
secondly, the intercompany agreements. I have noticed in most of the cases, the entities are just not entering into agreements with their related parties and are just doing the transactions without any basis. And what we do at the litigation stage, we'll frame an agreement for the entities on the back date. That just doesn't make sense because we have to plan everything at the litigation stage where things have been disclosed already, the transactions have already been conducted. So, second step, I would recommend entities to have good, solid intercompany agreements where the terms and conditions are mentioned uh, clearly, that what the Indian entity is supposed to perform in the agreement, what the foreign entity is supposed to perform, and the characterization of the entity. As we discussed, that if you're a captive unit, you can opt for safe harbor. That's a very good regime that the government has come up with. So we need to classify the entities also on the basis of that, whether we fall into the safe harbor regime or not. And the TP documentation, if these documents are solid, then our TP documentation will not have any flaws. With the benchmarking also that has been conducted, the filters that we select, I have seen in many cases the consultants are also sometimes lax on selecting the filters, checking what the entity is actually doing. That also becomes a very important exercise while we are doing benchmarking, to select the correct filters, to select the correct comparables, and the correct method also. What method do we want to benchmark with? Suppose if we want to benchmark with a comparable uncontrolled price method, and we have an internal comparable that we can see, okay, suppose the Indian entity is buying a raw material from a foreign company, and it is buying the same raw material from a third party. We can show that as a document,
Okay.
that the pricing is at market price. So we need to be very clear on what strategy are we adopting, what document, what method are we taking up, and the documents that we have to support that arguments.
So while we talk about the agreement, let's say if there is a foreign company, in that agreement should be something on some stamp paper kind of thing, or on a letterhead also this agreement will do.
So generally, the stamp paper, like these are the
Okay.
general agreements that we enter into uh, normally also, not just the transfer pricing I'm saying, but yes, a government stamped agreement holds more weight.
Okay.
Yeah.
And like while we are getting everything is done, audit is done, and then after that, one important question comes at times client is asking for that, okay, you have done this TP audit or you have prepared this transfer. See, normally they call it as a TP audit, right? So they understand that the chartered accountant and an auditor is bound to sign that TP report as well. Is it necessary to sign the TP report by the chartered
No,
accountant?
no, it's not. DP audit and the normal audit that we do under the Income Tax or the Companies Act, it's completely different. There are entities who get the TP audit done from the other experts, like me. I don't do normal audits. I do TP audits exclusively, so I can sign those forms. That's not a mandatory condition for the auditors to sign it.
No. For signing a form is one part, but I'm
Hmm.
talking about normally the clients are saying, okay, you have prepared this transfer pricing report, right? Where you have shown all benchmarking, how you arrived at particular assessment or a judgment, right? And then after that, they always expect that as an auditor, you have to sign that report as well. So I'm talking about that report. Definitely signing form is one part, right? If we
No,
talk
the
about
report is
48,
sorry. Yeah.
report is not required to be signed,
No,
right?
that's not required to be signed.
Okay.
The report,
So,
sir, is the responsibility of the management to prepare. Even in the
mm,
report, we mentioned that we have been hired by the management to prepare the report on their behalf. So it's not mandatory for a CA to prepare the report. The CA is expected to file the form correctly.
okay.
Yeah.
So here one question comes. Here we are saying that the report is required to be prepared by the management, and we are acting as an auditor. So let's say Narula sir is with us. So let's say Narula sir is preparing a report, right?
Hmm.
And Narula sir is the auditor also, right? And now the client is saying that, okay, Narula sir, because you have prepared that report on behalf of the management, you sign that report as well. So in that case, he will be ineligible to sign the audit because, as per the institute's code of conduct, if I am an auditor for any entity, then I am not allowed to do any other assignment. So, in as per your suggestion, he should not sign that TP study.
So generally, sir, we follow this model that the auditors are others, and the TP study is being signed by some other CA. But yes,
Hmm.
there is a practice of both the forms also. Like the auditor is the same, and the TP form is also being signed by the same CA. There have been no points raised on the behalf, but yes, the safer practice is to keep it separate.
Okay, but here we are talking about the safer practice. But as per the code of conduct issued by the Institute of Chartered Accountants of India, if I'm an auditor, so I can do the TP audit, I can do GST audit, I can do tax audit, I can do company audit, right? But while
Hmm.
we talk about preparing any study, which is actually is not an audit, and you said that that study is a responsibility of the management, right? So, don't you think that we should not sign the study, TP study, if we are acting as a TP auditor?
I agree, so that's what I told you, that this the auditor is not expected to sign the TP study, and I don't ever sign TP studies. As
Hmm.
the correct chronology is preparing the TP study first and then filing the form. So
Okay.
I will file the form on the basis of the TP study that the management has prepared. We are following the wrong chronology. We are doing the last step first. That is happening, but now that is being reversed. We need to prepare the TP study first, we need to do the benchmarking first, and then we have to file form 48.
Hmm. Okay, and there are cases which has where we have observed that the two companies are there, and both of them are the AEs, right? And let's say if there is a company based in India, and that company is rendering the services to its AE only, and
Hmm.
that company is not servicing, giving any service to any other company except its AE. So in
Hmm.
such case, how this benchmarking is being decided? Normally, it has been seen that the companies are rendering the services cost plus margin basis, or at times they are trying to render the services whatever the cost is coming. They are just recovering that cost, and then they are invoicing the AE on the basis of the cost incurred by them. So in that case, what should be the right mode of modus of operandi, so that as an auditor, we should report and we should conclude the TP audit.
Okay, sir. So the case that you described is clearly a captive service provider,
Correct.
which is providing the services only to its holding company, and is it's not incurring any risk. It does not own any intangibles. So the first step is, as I discussed, opting for safe harbor if the entity is applicable. And even if you're not applicable for safe harbor, is the selecting the correct method, either the cost plus method or the TNMM method, where we do the benchmarking, we conduct the search, we select the comparables, and we show. Suppose I'm taking an example of an IT company. It is providing cloud services to its holding company in US. So the
Hmm.
US company is remunerating the entity, the Indian company, at 15% margin. So we need to do a benchmarking where we find comparables where similar companies are providing services, and if they earn a 15% margin, or if our entity falls within the range, then we are good to go.
Okay. So, but what my point here is, here we are talking about cost plus margin or NNM margin, right? NNM method, right? But most of the time, what the companies are doing, they are just recovering their costs. They are not adding any margin for that particular profit center. They always call it as a back office support center, and they recover the expenses whatever they are incurring on that particular in that particular back office. They are not booking any profit here in India. In such case, what should be the right method? Because here it is actually not a cost plus method. As per my understanding, cost plus method is where I am adding some margin, right? Maybe small
Right.
margin, maybe 5%, 2%, 3%, or 10%, right? But I have seen the cases where the margin is not being added. They are simply recovering the cost. Let's say during the month of January, I have incurred 10 lakh rupees on a particular project. So I am recovering 10 lakh rupees. In the month of February, let's say I have incurred 7 lakh rupees, then I am recovering 7 lakhs. So I am not adding any margin. So what should be the right approach in such case?
Sir, see, these things depend case to case basis, and
Hmm.
we recommend also clients on case to case basis. I'll be happy to discuss this with you on a call if there's
Hmm.
any client of yours. But generally, we recommend our clients to charge some margins from the foreign entity if they are providing services. And if it's merely a reimbursement exercise, then you can opt for other method where you show the invoices. Like suppose my back office is here in India, and it is taking some services from a CA for something for the foreign entity, and the CA will definitely provide an invoice for the services rendered, and the Indian entity, the back office here, will be reimbursed from the foreign company. Then the document acts as the invoice that have been given acts as a valid document for the reimbursement.
So the best part in such cases, we should call it as a reimbursement of expense instead of invoicing the AE. We should raise the credit note or debit note where we can ask for. This is the reimbursement of expenses which we have incurred on behalf of the AE. Am I right?
Yes, but that depends on case to case basis.
That depends upon customers.
Yeah, yeah. This is just merely an example that I have
Yes,
given
yes,
you.
yes, I understand.
Yeah.
So really, I believe it was really a very nice deliberation. Members are with us. Very senior member P.K. Narulaji is with us. P.V. Gopalji, I believe he's from Aligarh. Mukesh Vashneji is also from Aligarh. Any of you is willing to ask any question, you are requested to kindly ask the question. Ajay Nagpalji is here from Noida. Many other members are there. So any of you is willing to ask, you can unmute yourself and you can ask the question, sir. Ajay Nagpalji is asking for, can you put form 48 on the screen? Just he wanted to see the sample. I believe forms have been notified yet under the new rule?
So, yes, so Form 48 is notified, but it will not be possible for me to share the screen as of the moment for the form.
Okay.
But it's
Okay.
available online, and the points that we have
Hmm.
discussed are there in the form. And
Hmm.
if anybody faces any issues, then they can connect with me.
So Nagpal sir, we will share that form 48 maybe on a WhatsApp. I'll try to find out that form 48 and I'll share on the WhatsApp to you. And I am sure you will be able to find out on the income tax site as well. But I'll try to share on your WhatsApp maybe by evening.
Yeah, and if there are any questions, sir can connect with me, and I'll be happy to discuss.
So you share your number also usual here so that the
I'll
members can connect with you. And I suggest the members, like even if you are looking for transfer pricing preparation of TP reports for your client, I believe usual will be able to help you out.
Yeah, I've put my number on the chat, so I'll put my email ID also.
And few of your members are from your hometown Aligarh. So
Yes,
I
sir.
believe Aligarh is already into the export of locks and all. So they are definitely going to get benefit from the member who is based in Aligarh only.
Yes, sir. I look forward to helping everybody.
Narula sir, would you like to share something? Narula sir, kindly unmute
मैं
yourself.
बात मैं बात कर रहा हूँ। और सही मायने में तो मैंने डेलीब्रेशन सुना नहीं, बहुत लेट एंट्री कर पाया, किसी मीटिंग में था और इच्छा थी
अच्छा
कि मैं
अच्छा
सुनूं कम से कम। मैं सुन
नहीं
नहीं
सर,
पाया
रिकॉर्डिंग
जो
रिकॉर्डिंग
लास्ट के
मिलेगी सर। रिकॉर्डिंग मिलेगी सर।
लास्ट 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 के ही जो डेलीब्रेशन जो क्वेश्चंस आप पूछ रहे थे, मुझे
जी
उतनी
जी।
नॉलेज हुई, अदरवाइज बड़े।
तो कोई इशू नहीं सर, विल शेयर द रिकॉर्डिंग ऑफ दिस डेलिब्रेशन टू ऑल ऑफ यू, सो आई एम श्योर you all are going to get benefited out of it. So
I'll
thank
share
you
the
usual.
presentation also, sir.
Yes, you
Yeah,
share the presentation as well.
yeah.
So thank you usual for your valuable time, and I'm sure in the time to come we will be having more sessions, not only in the transfer pricing. My only request is if you can share something about maintaining of books of account, especially in case of transfer pricing, because uh, Rule 48, 40, I think Rule 46, 48, 46 clause 8, right? And section 62 and section 58 are little confusing, and not only confusing, but it is creating a, you can say, fear among the SSEs, because that is talking about like if you are maintaining books of account electronically, then you have to have a backup on a daily basis. And having backup on a daily basis is going to be a very difficult task even for the small traders. right?
Right.
So it is going to be a very tedious process even for the small vendors. So I request you to kindly enlighten us on that part also whenever you get time. And then after that, we will do the analysis of that particular three sections, and then we'll share with the members. And I'm sure members are going to get members are going to enlighten themselves with the deliberation, or maybe with the note which you will be sharing with the members. Mukeshji, would you like to say something? I'm discussing this. This session is being taken by your fellow colleague from Aligarh only, Mukesh Vashneji. I think everyone is busy in finding out the points or maybe the questions. Srishti was asking for this recording. Srishti, you have any question? So I believe no one is having any question now. So let's close this session. Girish Narangji was on the way, so he could not continue for a longer time. So I would like to say thanks to everyone for joining this session, and I'm sure maybe in another, may not be in the next week, but next to next week we'll be having another session on the different topic. And will request Yojal also to come once again, maybe in the month of first week of August, so that because that would be the time where all members may be more and more involved into the audits. As of now, the members are more and more focusing on income tax returns, individual tax returns. So that may be the reason presence today is a little lower, but I believe in the month of August there may be more presence of the members. So with these words, I would like to say thanks to you, Yojal, and I'm really thankful to Narula sir. You also joined us here.
Thank you, sir.
Rajkumar
Thank
ji
you.
is there from Ranchi,
Welcome.
and so many other chartered accountants are there who have joined this event. So thank you so much once again on behalf of CICAS Welfare Association. And Narula sir, I just wanted to request you to kindly motivate the members who can be a part of this CICAS Welfare Association. This
Sure.
association we are developing for members and their families, because during the COVID, lots of members and their families were facing lots of difficulties medically, financially. So on behalf of SICAS, we wanted to help them out so that they should not face any problem in future, right? And the worldwide
Good.
situation is getting worse day by day. So we just wanted to have this SICAS Welfare Association as an entity who can hold the hands of members, and maybe in future we'll come up with a solution for students also, especially the students who wanted to be CA but they don't have the financial support or otherwise moral support. So we would like to support them through this SICAS Welfare Association. So I request you to kindly motivate the members, chartered accountants who can be a part of this SICAS Welfare Association. And
Sure.
it is not going to be a political organization. It is always going to be an organization who will be available for members and the students of the CA profession. With these words, I am really thankful to you, Yojal, for taking
Thank you,
this
sir.
delegation.
Thanks to
And I am
everybody for
just,
attending.
yeah, so I am just ending this meeting for now.
Yes.
Thank you so much.
Thank you, sir. Good evening.
Thank you.
Good evening.
Thank you. Good evening.